Hello students, welcome to my class. This is Professor Vicente Sagai. This is part 2 of chapter 7 presentation. Chapter 7, Auditing Internal Control over Financial Reporting. We left off in part 1 by defining internal control over financial reporting. We indicated that we define control deficiency. We talk about a significant deficiency, and we also talk about material weakness. Now, the issue here is, how do we determine the severity of the control deficiency? We said that we use 2 dimensions to make that determination. At the bottom of the slide, we have the likelihood, reasonable possible, and the magnitude, material significant or insignificant. Now, what does that mean? Let's take a look at this diagram to illustrate or to help us determine the significance of a control deficiency. Now recall, in intermediate accounting, we talk about the 3 classifications of contingent liability. Contingent liability deals with a liability that is contingent upon an event happening or not happening. And we said that we have 3 possibilities. Number 1, probable. Number 2, reasonably possible. And number 3, remote. If it is probable that it will happen, then we accrue for that contingent liability in our books. If it is reasonable possible, then we disclose it. But if it is remote, we don't do anything. So that as a background, let's take a look at likelihood. What does likelihood mean? We said that it is reasonable possible that a misstatement would not be detected or prevented. So that is likelihood that a misstatement will not be detected or prevented. Now let's take a look at magnitude. That is the second dimension. Magnitude relates to the impact, the material, the severity that the control deficiency could have on the financial statements. So the impact or the severity that the control deficiency will have on the financial statement. Now, how does this work? Now let's take a look at this diagram. Take a look at, on the left side we have remote. Remember the 3 classes of the 3 scenarios or possibilities of classifying contingent liabilities. Probable, reasonably possible, and remote. So here we say that if it is remote, that misstatement will not be detected or prevented. If it is remote, then irrespective of the potential magnitude or the impact on the financial statement, whether not material or significant, or not material but significant, or material, if it is remote, then the control deficiency is not an issue. All right? Now, on the right side, let's take a look at the likelihood. Here we have 2 possibilities: reasonably possible or probable. So if it is reasonably possible or probable that a misstatement would not be detected or prevented by the internal control, number 1. Number 2, let's take a look at the magnitude side. The impact or the severity of the financial statement in terms of the impact that it will have is not material or significant, then we have a control deficiency. Then in such circumstance, we will report it to management. Again, let me back up here. So we are using these two dimensions, likelihood and magnitude, to help us determine how severe the control deficiency is. So let's take a look at another possibility. If it is reasonably possible or probable that a misstatement would not be detected or prevented by the internal control, and the impact of that on the financial statement in terms of the magnitude is not material but significant, then we have a significant deficiency. So we report it to the audit committee and to management. Now, if it is reasonably possible or probable that misstatement will not be detected or prevented by the internal control, and the potential impact or magnitude on the financial statement in terms of the significance is material, then we have a material weakness. In such circumstance, we have to report it externally to the audit committee and to management. So the most important thing that I want you to know here is the likelihood and magnitude help us to determine the significance of the control deficiency. Moving along, let's take a look at management assessment process. Recall at the beginning of the chapter we said that the act or the law requires management to take responsibility for establishing and maintaining adequate internal control over financial reporting. And management has to take responsibility for an effective internal control over financial reporting. Consequently, management has to have an assessment of their internal control. What do we mean by assessment? They have to evaluate the adequacy. Of course, the word that they use, adequate. The law did not clearly define what is adequate, but it said that management has the responsibility of establishing and maintaining adequate internal control over financial reporting. So management have to evaluate or analyze or assess or rate their internal control in order for them to put the necessary things in place to make sure that the controls are not only working or adequate, but that the controls are also effective. So take a look at the management assessment process. So management will follow a top-down risk-based approach. We are going to talk about this in a minute. So management will identify financial reporting risk and controls. So what are those risks? What are those controls? They will consider whether locations, they will consider which locations to include in the evaluation, and they will also evaluate evidence about the operating effectiveness of internal control over financial reporting. So now, how does management go about his assessment? What kind of criteria do they use? What basis would they use? Now, most companies use COSO framework. So framework used by management to conduct this assessment, we said most entities use the framework developed by COSO. We talked about this organization previously. That is the committee of the sponsoring organizations, okay? Now, the framework identifies three primary objectives of internal control. These are three main objectives that we want the internal control that we put in place to accomplish. Number one, reliable financial reporting. Number two, effectiveness and efficiency of operations. And number three, compliance with laws and regulations. So management use COSO framework to conduct this assessment because COSO framework is very credible, and it is, like I said, it is used by most corporations. Now, let's take a look at the entity level controls. What do we mean by the entity levels controls? When we talk about entity level controls, we are talking about those controls that have general or widespread or pervasive impact on the whole organization. So we are not talking about specific controls that make sure that a particular issue is being addressed. We are talking about entity level controls, controls that are widespread. And we said that these controls are divided into two categories. Number one, we have the control environment, and number two, we have the period end financial reporting process. So the control environment, remember we discussed that previously, it is more or less like the tune at the top of the organization. In other words, how serious is management? How serious is the board of directors in relationship to internal control issues? So we look at those controls relative to control environment because those controls have a widespread impact on the whole organization. Then we also take a look at the period end financial reporting process. In other words, what kind of process does management put in place to make sure that at the period end, that is accounting period end financial reporting process, are adequate, effective in order for us to generate reliable, complete financial statements in accordance with GAAP. Now, management documentation. Management is also responsible to develop sufficient documentation to support its assessment of the effectiveness of internal control. So management is not only assessing the effectiveness of internal control, they also have to develop documentation to support its assessment. So here are some of the approaches that the management could use. Paper, electronic files, or other media. It could also include policy manuals, process model, flowchart, job description documents, form, so on and so forth. So moving along, let's take a look at integrating the audit of internal control and financial statements. What are we talking about here? We remember we're talking about integrated audit. Here we are talking about auditing financial statements and auditing internal control simultaneously or concurrently. So we call that integrating the audits of internal control and financial statements. What you need to know here is the fact that when auditors are testing or auditing internal control, definitely they are going to do more work, more testing of internal controls that they would do if they are just understanding internal control for the purpose of planning the audit and determining the nature, timing, and extent of the test to be performed. Here they are actually doing a full-blown audit on the internal control. So from that standpoint, they are going to have a better understanding of internal control. That understanding will help them with their detailed testing or substantive audit procedures. At the same time, their detailed testing procedures will also help them with their audit of the internal control. So it's concurrent, and there is a lot of elements of overlapping relative to this integrated audit of controls and the financial statements. So that ends. That is the end of part 2 of this presentation, and we will take it from there or from here in part 3.